China's strategic cancellation of U.S. soybean contracts. China has cancelled 16 major soybean contracts with the United States, significantly impacting export numbers and demonstrating China's capacity to inflict economic damage without military engagement. This calculated maneuver creates ripple effects throughout global supply chains, extending well beyond immediate financial losses. China's ability to substitute U.S. suppliers with alternative sources strengthens its negotiating position and reveals a potential long-term strategy to reshape global trade relationships. The cancellations serve as a clear message that economic leverage can be wielded as effectively as traditional power projections in international relations. Don't miss our latest updates on global trade developments. Subscribe to our channel now for in-depth analysis and expert insights on international economic shifts. Missouri farmers are projected to incur substantial losses estimated at $1.1 billion in 2025 due to these contract cancellations. This represents not merely a financial setback but a fundamental alteration in trade dynamics between the two nations. The impact cascades beyond primary producers to affect processing facilities and auxiliary industries that depend on stable agricultural exports. Long-term market disruptions are anticipated in the export sector as relationships with Chinese buyers, once severed, may prove difficult to re-establish. The cancellation has strategic implications regarding 42,000 acres of land previously controlled by WH Group, the parent company of Smithfield Foods. This indicates China's message extends beyond trade to include potential control over agricultural resources within the United States. The situation raises concerns about foreign ownership of critical agricultural assets and may influence future political and economic decisions regarding land ownership and food security. National security implications emerge as agricultural production capabilities increasingly intersect with geopolitical considerations, potentially leading to new regulatory frameworks concerning foreign investment in agricultural land. Global trade rebalancing. China, which manages approximately 13% of global trade, is redirecting its focus from U.S. markets to Brazilian suppliers, threatening the United States' position as China's primary trading partner. Brazil has emerged as the dominant supplier of soybeans and grains to the Chinese market, capitalizing on opportunities created by trade tensions between the world's two largest economies. These developments are contributing to a restructuring of global trade patterns and reduced dependence on traditional market leaders. The shift represents a strategic realignment that may permanently alter established trade relationships and create new economic dependencies. Food prices in the United States are projected to increase by 6.4% in 2025, according to the U.S. Department of Agriculture, with average monthly household food expenditures expected to rise by approximately $47. These increased costs will place additional financial pressure on American consumers already managing inflationary pressures in other sectors. The situation may exacerbate broader economic challenges and reduce disposable income for discretionary spending, potentially affecting retail sectors beyond food. Consumer sentiment and purchasing behavior may shift in response to these pressures, creating secondary economic impacts across various industries. Over a 17-month period, China has systematically reduced its U.S. Treasury bond holdings from $1.06 trillion in 2021 to $816.3 billion currently. This represents a strategic initiative to reduce dependence on the U.S. dollar and minimize exposure to potential sanctions or economic pressures. China is diversifying its financial reserves through alternative assets such as gold and other currencies, creating a more resilient financial position less vulnerable to unilateral U.S. actions. Since 2022, China has purchased over 300 tons of gold, bringing total gold reserves to 2,213 tons as of February 2025. This acquisition strategy provides China with assets that cannot be easily frozen or devalued through external actions. Canada's strategic energy realignment. Canada previously directed 97% of its energy exports, valued at 176 billion Canadian dollars, to the United States, creating a highly dependent relationship. Following proposed 10% U.S. tariffs on Canadian oil and gas imports, Canada began actively diversifying its export markets to reduce this vulnerability. Rang Pro Chemical, a Chinese refining company with 800,000 barrels per day processing capacity, strategically established operations in Calgary to capitalize on this market opportunity. Initial agreements were secured with Suncor, with shipments scheduled to commence in June 2024, marking the beginning of a significant reorientation in Canadian energy export strategy. Rangshong is actively pursuing negotiations with additional major energy corporations including Cenovus, Shell, BP, and ConocoPhillips, signaling a comprehensive approach to securing Canadian energy resources. The companies have implemented flexible free on-board (FOB) arrangements allowing destination changes during shipment, maximizing adaptability in a dynamic market environment. This strategy is being coordinated by Wangzhe, who established ProChina's energy trading division in the Canadian market with considerable expertise in international energy transactions. The Trans Mountain Expansion (TMX) project, completed in early 2024, spans approximately 1,200 kilometers and has tripled capacity from 300,000 to 890,000 barrels per day, representing a transformative development in Canadian export capabilities. The project enables direct access to Pacific ports without transiting through U.S. territory, eliminating a significant constraint on Canadian energy export flexibility. This infrastructure development allows direct access to Asian markets including China, Japan, and South Korea, where refineries are specifically designed to process the heavy sour crude that Canada produces. Following threatened U.S. tariff policies, the Canadian government implemented a $6.5 billion Canadian support package, with $5 billion allocated to help businesses access global markets and $1 billion directed to the agricultural sector. The LNG Canada project in Kitimat, British Columbia, backed by Shell, ProChina, and Mitsubishi, is progressing toward completion with LNG exports projected to commence by late 2025. Current Canadian gas exports total approximately 8.6 billion cubic feet daily, primarily to the U.S., but new LNG port development from the Pacific to the Arctic will enable Canada to establish independent access to global gas markets. Consequences for U.S. energy markets. Canada's redirection of energy exports has resulted in approximately 11 million barrels being diverted from U.S. supply within a 3-week period, creating immediate market pressures. U.S. refinery utilization has declined from 89% to 71% capacity as facilities designed for Canadian heavy crude struggle to secure adequate supply volumes. These disruptions have contributed to increased fuel prices nationally, affecting both consumers and industries dependent on stable energy costs. The reduction in supply affects multiple economic sectors beyond direct energy consumers, highlighting the interconnected nature of energy markets and broader economic activity. Goldman Sachs analysts project potential U.S. GDP decline of 0.8% with a mild recession in Q2 2025 considered possible if current conditions persist. Supply shortages are affecting multiple industries including steel production, where raw material costs have increased by 22%, and food supply chains experiencing similar disruptions. Price increases are occurring across various consumer goods categories, creating inflationary pressures that may necessitate monetary policy responses. The cumulative effect of these disruptions illustrates the vulnerability of the U.S. economy to changes in established trade relationships and energy supply patterns that had previously been considered stable and reliable. China's LNG import realignment. In March 2025, China announced the suspension of all LNG imports from the United States, representing the loss of a $2.4 billion annual market for U.S. exporters. This action appears to be retaliatory following a 10% U.S. tariff on Chinese goods the previous month, demonstrating how trade tensions in one sector can rapidly spread to others. The decision affected the U.S., which was the world's largest LNG exporter in 2024 with 91 million tons of production, creating significant challenges for an industry that had made substantial investments based on projected Chinese demand. China has redirected LNG shipments to European markets, avoiding U.S. tariffs while expanding influence in a region urgently seeking energy alternatives to Russian supplies. European nations including Germany, the Netherlands, and Italy have adjusted import policies to capitalize on Asian LNG availability, demonstrating the flexibility of global energy markets. The European Union has expanded storage capabilities and infrastructure to accommodate increased imports, accelerating plans that were already underway following energy security concerns. Australia has secured a $1.5 billion contract with China Resources Gas, establishing a 15-year agreement to supply 600,000 tons of LNG annually beginning in 2027. Australian LNG offers 20% cost savings compared to American supplies due to both market conditions and more favorable trading relationships. Transportation time is reduced by approximately 10 days due to geographic proximity. providing logistical advantages that enhance the economic attractiveness of this partnership. China has systematically reduced U.S. LNG dependence from 20% to 5% of total imports as part of a broader strategy to enhance energy security through diversification. U.S. LNG export terminals are experiencing increased inventory and cancelled contracts as they struggle to replace lost Chinese demand with alternative customers. Shipping costs have escalated due to market disruption, further challenging the economics of U.S. LNG exports to distant markets. Australia has surpassed the U.S. in LNG market share for Chinese and other Asian markets, capitalizing on both geographic advantages and more stable trading relationships. Tariff policy analysis and market response. The Trump administration implemented tariffs as a mechanism to strengthen the U.S. economy, with claims including expectations of hundreds of billions in tariff revenue and enhanced national economic strength. Initial implementation targeted major trading partners including Canada and Mexico, creating immediate tensions with neighboring countries that had previously enjoyed relatively frictionless trade. The policy was presented as a strategy to rebalance trade relationships and protect domestic industries from foreign competition, appealing to economic nationalism. Stock markets experienced significant declines following tariff implementation as investors reassessed growth prospects and profitability in a more restrictive trade environment. Unemployment rates increased as businesses adjusted to new cost structures, particularly in industries dependent on imported components or export markets. Consumer spending decreased in response to economic uncertainty and higher prices for affected goods, dampening overall economic activity. Recession concerns emerged in financial analyst reports as cumulative effects of trade disruptions began to impact broader economic indicators. Tariff policies were characterized by frequent modifications, suspensions, and re-implementations, creating an unpredictable regulatory environment that complicated business planning. The unpredictable nature of policy changes created planning challenges for businesses attempting to establish supply chains and pricing strategies in an uncertain environment. Strategic decision-making was complicated by regulatory uncertainty, leading many businesses to delay investments until policy directions became clearer. Price increases were observed across multiple sectors, including housing, food, and imported goods, creating broad inflationary pressures despite claims that tariffs would primarily affect foreign producers. The trade deficit, which tariffs were intended to address, showed limited improvement as import substitution proved more challenging than anticipated and retaliatory measures affected export markets. Long-term benefits promised by policy advocates remain unsubstantiated, with empirical evidence suggesting that the economic cost of policy implementation appears to exceed projected gains. The disconnection between predicted outcomes and actual results has created skepticism regarding the effectiveness of tariffs as tools for economic policy, particularly when implemented unilaterally rather than as part of coordinated international agreements.